Good morning, everybody. This is Greg Gossett from Gossett Trading and Mentoring, and today is Saturday, November 2nd, 2024. Hey, I hope you're doing well. I hope you had a good trading week last week, and I hope you are enjoying your weekend. And thank you for coming to my weekend review. I hope it's going to be helpful for you. The format for today's podcast is, first of all, we're going to run the U.S. legal disclaimer. Secondly, we're going to come back. We're going to take a look at all the trades that I made last week, all the positions that I'm still in, all the closed positions, and we'll go through each trade, both open and closed. We'll talk about when I entered the trade, why I entered the trade, what was the reason, what was the setup, what was the strategy, what were the confluences of signals that made me decide to enter the trade, and then how I am going to set up and format the trade with my emergency stop, with my end of day stop, how I'm going to take partial profits if it starts to move my way, what I'm going to do when it gets to trailing stop level, and then looking at other serious overhead resistances levels as well. So just to give you an idea, give you a glimpse into how I set up trades, how I manage the trades going forward, and I hope that's going to be helpful for you. And if it is, I would appreciate it if you could hit the thumbs up button anytime during the podcast if you find something of value. After that, we're going to talk a little bit about trader psychology. Trader psychology is the most important skill in trading, the ability to create a plan and then to follow the plan. You can have the best plan in the world, but if you don't follow it, what good is it, right? It's very important that you create a process. There's lots of different ways to create a process, whether it's a process like I use or other people use. There's many good processes out there, but the key is knowing exactly what you're going to do when if the market goes your way, what do you do? If it goes against you, what do you do? And it's just all about creating a process and the importance of following that process. And that's why I like to teach a little bit of trader psychology each podcast, because it really is so important. And then after that, I have gone down through my watch list. I went down through my master watch list last night, both on the daily time frames and the weekly time frames, and I did identify some potential trades for next week. Now, they're not where they need to be yet, and that's just part of my process of looking at charts, going down through each one and saying, if it went down a little bit more to here, that would be a really good confluence of a really good confluence area. Maybe there's a 200-day moving average there. Maybe there's a double bottom with a bullish divergence there. Maybe there's a low 30 RSI. So in my experience, I'm trading over 29 years. What I like, how I trade and what I teach is looking on the weekends for just the perfect spot, right? The perfect pitch across the plate. And if it gets there, well, there you go. Now you can potentially enter the trade and you can structure your trade from that perfect spot. It's not always going to work out, but in my experience, it works out more than it doesn't. And if it doesn't get there, that's fine. You just move on to another market that does get where you want it to go. And there will be something. I'm almost, I don't want to promise, but I'm very, very secure in saying that for sure, eventually something will get to your area, and that's when you have to make the decision if you're going to take it there. And like I said, having a good trade plan, having a good risk reward ratio, position sizing correctly, and knowing what you're going to do. So I have identified both on the daily time frame and the weekly time frame what I am looking for next week, and so I hope that's going to be helpful for you as well. And I have both the Qs and the SPY on there because last week on Thursday there really was a big change in the structure of the market, which is important to know because it kind of gives you some headlights into what I think is coming more than likely. I mean, it could change, but more than likely, we have broken structure to the downside on multiple metrics, both on the Qs and the SPY. So in that case, I would probably be looking for some shorts if we rally back up. But we'll get into it. And like I said, hope it's going to be helpful for you and that you're going to learn something today. And if you have any questions or comments, put them in the comment section. I'll do my best to reply to them as well. So let's get going, get the U.S. legal disclaimer out of the way, and then we'll get started. So hang tight.
This video or live broadcast, like all instructional materials produced by Gossett Trading and Mentoring LLC, is created and published for informational and educational purposes only. Please carefully read and/or listen to the U.S. government required disclaimer before watching this video or live stream broadcast. The video link and disclaimer text are located in the description section of this video or live broadcast, here and here. Thank you so much.
All right, let's get started here. And on this first one, I'll go through, I'll spend a little more time on this one, just to go through all the rules that I have, and then the trades after this I won't spend as much time on, so just letting you know that right as we start. So I use and I teach 7 different trading strategies. So we have a variety of them today, so we'll go through each one. And this one here is called a deep dip buy. Deep dip buy incorporates the 200-day moving average, the 250-day moving average, the 300-day moving average, and or a rejection of the 30 RSI. So in this case, the 30 RSI does not come into play, but the black line is the 200-day moving average. This is the key level that traders, large financial institutions and savvy traders, this is a key level of support. There generally are buyers at the 200-day moving average. So I entered the trade here on the 15th of October. Why? Well, the previous day, or 2 days before the day I entered, it closed below. The next day we closed above. That is a legitimate signal, just to close under, close over the 200. I didn't buy it that day. I decided to give it one more day to see what happened, and on the next day where I bought it, it came back a little bit, got closer to the 200-day moving average. And so what that does is it gives me a better risk to reward ratio. So the first thing, and we're going to talk about this in trading psychology, but really when it comes down to trading, the most important thing, and I've had people argue with me about this, but I still think I'm right, right, is the position size. Because if you have too large of a position size, even if you have a great setup, I mean, of course it can go against you, right? I mean, there's no law saying that if you have a good setup, it has to work. So if your position size is too large and it dumps on you, you're really, really in trouble. So if you take a great position size, if you take a great entry with a moderate position size, or a position size that uh, is correct for your trading account, then okay, you have a little loss. It's fine. It doesn't hurt anything. But if you go too big, then you can sustain some damage, and then there can be a snowball effect from them. So let's first of all talk about how to position size. So the way that I do it is based upon the 2 ATR reading. Right now it's $8.95, and the account value. So let's just say I have a $50,000 account, a trading account. So if I have a $50,000 trading account, I take 1% of that account. So $50,000 times 1% is $500. That's going to be my maximum allowed risk on this trade in the worst case scenario. If I have a $100,000 trading account, it's $1,000. If I have a $1 million trading account, it's $10,000. If I have a $25,000 trading account, it's $250. So let's just start with the $50,000 trading account. 1% of that is $500. I take the $500, divide it by the value of the 2 ATR, whatever the value is on the day that I bought it. Right now it's $8.95, but back here it was different, right? Because every day it changes, but let's just say it was $8.95 divided by $8.95. It's telling me to buy 55.86 shares. Well, I can't buy 8.86, so I just rounded up to 56 shares. All right. So I have my entry. It's the under over the 200 on the deep dip buy, pulled back a little bit, still makes it a legitimate trade. I entered at 266.40, and I position sized with the 58 shares with the math that I just showed you. Now, the first thing you do, or the first thing I do is remember the $8.95, the 2 ATR that we did the math with? Okay, well, for my entry, I go down $8.95. This is my emergency stop. If I ever get to this level, I'm just simply out. It doesn't matter if it's 1 minute after the market opens or 1 minute before the market closes. If it gets there, I'm simply out. Now, and how much would I lose? I would lose the $500, right? Because I take the 58 shares times the 895 down here. That would be my $500. No fun to lose that, but the good news is that only happens about 5% of the time. Emergency stops are only hit about 5% of the time. 95% of the time, your end of bar stop will come into play. So I have the emergency stop down here, 2 ATRs below. My end of bar stop is going to simply be if we close below the 200-day moving average. Even a penny, I'm simply out. My support level was lost at the end of the day, right? Because other than the emergency stop, I base everything on the end of bar close because the closing price is the most important price of the day. You have the large financial institutions, they're making their end of day decisions. They have very smart people, they're dealing with the most money, they have best technology. I want to follow what they are doing. So if it loses the 200-day moving average, I'm simply out. Even like I said, even if it's 1 penny, I'm out for a small loss. Or it could, close down here, down here, down here, whatever. But like I said, 95% of the time, your end of bar stop's going to come into play. Your emergency stop's only going to hit about 5% of the time. So we had the under over 200 on the deep dip buy. I position sized correctly. I got in 266.40. I placed my emergency stop 2 ATRs below. My end of bar stops closed below the 200. Now, I also take my entry price and I add the value of the 1.5 ATR. Right now it's 671. So I take my entry price, I place the line up here, it's this orange line, 1.5 ATRs above. Why do I do that? Well, if it gets to 1.5 ATRs above my entry, then I go into what is called trailing stop mode. Trailing stop mode just means once I'm in it, now in the future, if I have a close below a previous bar's low, I'm going to exit half of the position. So if you move 1.5 ATRs, you're starting to have a pretty good trade. And I don't want to give it all back if it heads back down. So if I have that first close below a previous bar's low, I sell half. Selling half is one of the best things you can do. It's one of the only win-wins in trading. If you sell half and it continues to go down, you're glad you sold half. If you sell half and it continues to go up, you're glad that you still have half. So, I placed that 1.5 ATRs above. Now, the last thing that I want to go over is the position sizing, the emergency stop, the end of bar stop, going into trailing stop mode. These are all defensive moves. If something goes against me, then these are defensive rules. So I do something because it's gone against me. But I also like to play offense in my trading. And the way that I do this is that I sell into strength a portion of my position, not all, but a portion. And the way that I do this, it's based upon the closing price of each day. So right now on FedEx, the closing price is 274.35. So what I do is I take 274.35, which is is the closing price of the last day, and then I add to it the value of the 0.45 ATR. Right now, that 0.45 ATR is $2.01. So the closing price plus 2.01. My first profit target for Monday is 276.36. So I'll put a limit order in to the system for Monday only to take off 10% of however many shares if I have remaining. So if I have 100 shares, I would place an order for 10 shares at that 276.36. So the first profit target, 276.36. I'm going to add the 0.45 to it again, plus 2.01. The second profit target on Tuesday is going to be 278.37, and I'll place another limit order in for those 10 shares, right? And then we'll do it one more time. Second profit target plus 2.01. My third profit target is going to be 280.38. Now, obviously, if the stock goes down, you're not going to hit any of your profit targets. If the stock goes up big, you may hit 2 profit targets. You may hit 3 profit targets. I've hit 7 profit targets before. But kind of on a normal day, you may hit 1 profit target. But what you're doing is you're selling into strength. You are reducing your position size into strength. And you'll see, especially when we get to the UNG trade, why that was so important. All right. So that's how I set my profit targets. So now we kind of know everything, right? We had the under over 200-day moving average. We position size correctly. We have our 2 ATR emergency stop below. My end of bar stops are closed below the 200-day moving average. I set my trailing stop level 1.5 ATRs above, and I take partial profits if it starts to go up, at least the value of the 0.45 ATRs. So on this trade, I entered at 266.40. The next day, it moves up enough for me to take a profit target. The next day, moved up again, enough for me to take a profit target. So I'm reducing into this strength. Then the next day, it went up a little bit, not enough for a profit target. Then we came down. We had a close below previous bar's low, but I did not do anything because I did not hit trailing stop level. Then we started to come down, getting close to my end of bar stop, right? If it had closed below the 200-day moving average, I would have just gotten out here, but the support held. Then we gapped up big, and I hit multiple profit targets at the open because I had programmed the limit orders in, right? I think I hit 3. I think I hit 3 profit targets on that open. So it's a nice feeling, right? You got all of them at the big gap up open. You're continuing to reduce your position size. And I'll tell you, one of the benefits of that, of reducing your position size, is now you have the flames to your feet are lower and lower and lower. And why is that important? It helps you follow your process better. If you have lots of shares, you may go, oh, that's enough. I'm out, right? Your process, your plan didn't tell you to get out, but you just got out because of the emotional stress about it. So that's another advantage of taking the profit targets. And then we move down the next day. Oh, and by the way, on this day here, I got to trailing stop level. So now I'm in trailing stop mode. If I have a close below previous bar's low, I'm going to get out of half. Well, then we've just kind of moved sideways here ever since that big gap up day. We did not close below a previous bar's low, so I am still in the trade, and this particular trade currently up 2.91%. So pretty good trade so far. Rio. Okay, Rio is another deep dip buy. You can see the 200-day moving average, the key line here. Now, in addition to this, and you've heard me talk about this many times, look at the gray line. The gray line is the 50-day moving average. If the 50-day moving average, the gray line, crosses over the black line, which is the 200-day moving average, this is called a golden cross. This is a good indication that things are starting to get better. What I have noticed is once you have a golden cross, the first pullback to the 200-day moving average is generally a place where it tends to bounce. So that is a confluence. Not only did I enter because we had an intraday rejection of the 200-day moving average, that by itself is a legitimate signal, but the golden cross prior to that makes the trade better in my opinion. So I had the intraday rejection of the 200-day moving average and the golden cross. I got long here, 64.49. I position size correctly based upon the formula that we discussed. I placed my emergency stop 2 ATRs below. My end of bar stop is simply a close below the 200-day moving average. Okay, then I placed my 1.5 ATR trailing stop level above, which I did, and the next day, didn't do much, went under the 200 during the day, but closed back above at the end of the day, so it kept me in the trade. The next day, moved up, enough for me to hit a profit target. Next day, moved up, enough for me to hit a profit target. Next day, moved up, enough for me to hit a profit target. So I'm reducing my position. And on this particular day here on the 29th, we also got to trailing stop level. Now I'm in trailing stop mode, which means in the future, if I have a close below previous bar's low, I'm going to get out of half. Well, that happened the next day here on the 30th. It closed below the previous bar's low after reaching trailing stop level. I took off half of the remaining shares that I had for a gain of 2.17%. And then Thursday, we came down, obviously no profit targets there, but it still held the 200-day moving average, so it kept me in the trade. Friday, it gapped up enough for me to take a profit target. So on Wednesday here, I sold half of the remaining shares, and then the remaining shares that I have up 1.22. So I took half with a close below a previous bar's low after reaching trailing stop level, half of the remaining shares for 2.17, and the remaining shares that I have up 1.22. All right, so that is Rio. UUP. All right, this is a little different kind of trade, not a deep dip buy. This is what is called a island reversal. And island reversals, I'm sorry, not an island reversal, abandoned baby and island reversals. They're very, very similar. Babies just consist of one bar. If it's more than one bar, it's considered an island reversal, but it's the exact same strategy. So I got short here on the dollar on the 25th of October. Why? Well, look here at this red bar. Why is this? Why did I mark this red? I marked it red because we gapped up, and then the very next day we gapped down. So for whatever reason, the news, the sentiment of the market was very bullish, and then immediately followed by bearish. When this happens and you look out into the future, more times than not, this price will be lower. You can have a bullish abandoned baby, and I'll show you some of those as well. If you can have a bullish abandoned baby, which, let me see if I have any on this chart. No, not on this chart, but I will in a little bit. So we gap up, we gap down. More than likely, in the future, you're going to be lower. So I could have entered the trade right here at the open. I could have entered the trade at the close. But what I like to do is wait for a little bit of a check back to the bottom of the baby. That's generally a pretty significant resistance level. And so I got short here, 29.28. Now, on this particular strategy, I don't take partial profits. I don't have trailing stop levels, emergency stops, all that kind of stuff. What I do, I just make this one very, very simple, and I have a 2 ATR stop and I have a 4 ATR profit target. So I'm short, so I place a 2 ATR stop. And remember now, position sizing, if I hit that stop, I've lost 1% of my account. But to the profit side, it's twice what the stop is. So the stop is 2 ATRs, the profit target is 4 ATRs. In my experience, this particular setup works about 70% of the time. So 70% of the time, I'm going to make twice as much as I lose, because 30% of the time, I'm going to lose 2 ATRs. 70% of the time, I'm going to make 4 ATRs. So this one's very, very simple. And so I shorted here 29.28. Next day was broke about even. Next day it gapped up. It wasn't looking too good. Then we came down, 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 looking better. And then Friday again, of course, with bonds prices going down, the dollar rose. So still in the trade, has not hit my 2 ATR stop, has not hit my 4 ATR profit target. And currently, this particular trade down 0.14%. INDA. Okay, so INDA, yeah, this is the one I was talking about. INDA is a bullish abandoned baby. You you can see in the blue box here, the previous day we gapped down, followed by an immediate reversal, gap up. When this happens, more than likely in the future, this will be higher. But I don't know that for sure, and it doesn't always happen, so I have to place my stops. Okay, so I entered here 55.16, 2 ATR stop below because I'm long, 4 ATR profit target above. So two things are going to happen. I'm either going to hit my 2 ATR stop or I'm going to hit my 4 ATR profit target. So I just set this trade and forget it. Over here, this is a good example, everyone, of a island reversal. See how we gapped up? And then we moved sideways, 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 and then we gapped down. And was that correct? It sure was. Big time. That bearish island reversal bar just nailed it. So will it nail it this time? I don't know. I hope so. That would be great. Here's another one right here. See how we gap down and then a gap up? That's a bullish island reversal here, and that certainly nailed it. You see the green here. The green, this is an order block. Again, this is another one of the strategies that I use and that I teach. And so the reason I took this trade was, one, it had the abandoned baby, and two, it fell inside the green order block here, which is another area that more than likely it will bounce. So that's the confluence of the trade, inside the green order block, and then also the entry trigger of the baby, the bullish baby. But even with all that said, down on the trade, right? It doesn't matter how good the setup is, it's down 0.6%, right? So not to my 2 ATR stop yet, but I like to wait for just the best signals, the best confluences, but of course they don't always work, right? So that's why you have to position size correctly. That's why you have to know exactly what you're doing. And, in the worst case scenario on this particular trade, if it does get down to my 2 ATR stop, how much do I lose? 1%. If it gets up to my if I hit my 2 ATR stop, I lose 1%. If I hit my 4 ATR stop profit target, I'm going to make 2%. So this one down so far. Oh boy, this trade, not so great. Really good setup, a lot of babies. This was a baby. You can see the green bar. We gapped down, and the next day we gapped up. We broke the trend line to the upside. We came back down to the top of the baby. This one just has not worked. This has been frustrating with bonds. It's really been frustrating. So I entered here on the 30th of October, 92.30, 2 ATR stop, 4 ATR profit target. It seemed like it was holding, had a little reversal on Thursday, and then Friday just got crushed. So anyway, this one definitely, if it goes down another 50 cents or so, I will be to my 2 ATR stop. And what do? I just have to get out of the trade. That's it. I just have to follow the rules. But maybe we'll reverse back up here, hit the 4 ATR profit target. I don't know. I hope so, but I have no control over it. So I have to have my rules in place. And this particular stock down 1.6%. By the way, if you'd like to learn more about abandoned babies and island reversals, if you go to my YouTube channel, I have a lesson there where I go into a little bit more detail about it. But I've had people tell me that's a helpful video. So TLT down 1.6%. All right, AGQ, another abandoned baby. Man, I don't think I've ever, in all the years that I've done the podcast, have had so many abandoned babies. And thankfully, this one's going my way. Okay, this is on AGQ. This is double leverage silver. Here's the red bar. Why is it red? Because the previous day we gapped up at the open, and then the next day, boom, gap down. That's indicating that we went from a very bullish sentiment to a very bearish sentiment quickly. Now, I could have shorted here. I did not. I wanted to wait for the price to come back up to the bottom of the baby, and that's exactly where I got short. I got short here at 48.40 because it's an abandoned baby. 2 ATR stop above, 4 ATR profit target below, and this one just nailed it. This one's doing really well. This particular one at current is up 12.82%. So yeah, these are one of my favorite strategies. Like I said, I've just shown you a couple trades where they didn't work, but this is one of my favorite strategies, and this one made up for all of them. So anyway, if we get down to the 4 ATR profit target, I'll just get out of the trade, and that will be that. But doing well so far. All right, let's get to the last open trade that I have. This is on WBA. This is Walgreens. And this is what is called a return to value V1. I had a trading friend of mine. We had a call last week where we were going over all the different strategies that I use and I teach. And we were talking about V1s, V2s. And I told him, I said, it has been a while with this crazy market. It has been a while since I have seen a legitimate return to value V1 or V2. And voila, on Thursday, here it is. I haven't talked about this for a while on this podcast because we just haven't had them. So this is a nice breath of fresh air. So what is a return to value V1 or V2? Let's take a look at the two green lines here. There's the top green line and the bottom green line. Anywhere within these green lines, we'll just call it a channel or a band, is called the value zone. Now, I don't like to buy above the value zone. I like to buy below the value zone, sell in the value zone, or buy in the value zone and sell above the value zone. So everybody rushed out to buy WBA up here. Well, they're underwater on the trade because generally buying up in these levels is not sustainable. I like to wait for it to come back into the value zone. And that's exactly what it did. Now it is back in the value zone. So the rules for a V1 or V2 is one, you have to start above the value zone. Secondly, you have to come back into the value zone, which we have. Then you need to have some sideways motion, which is very important. It shows there's an equilibrium, an equal amount of buyers and sellers. And once that happens, now you're ready for a V1 or a V2. So it has to be above the value zone, come back into the value zone, sideways, 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 and then the entry for the trade. Oh, sorry, I did not. Let's see. 943. Sorry, everybody, I didn't mark that up. I don't know why I didn't do that. 98 cents, yeah. Right about here. What am I doing? It's my emergency stop, right? That's 2 ATRs below my entry. I have to know where that is. And there it is. Okay, so back to the trade. Above the value zone, pull back into the value zone, sideways motion. Now I have to wait for a V1 or a V2. If you'd like to learn more about V1s, V2s, again, on my YouTube channel, I have a video about them. They're in the lessons playlist. But this is a V1. What is a V1? A V1 consists of two bars, bar 1 and bar 2. And the rules are, if for a V1, bar 2 must go below bar 1's low and then close above bar 1's close. That is a textbook perfect return to value V1. Above the value zone, back into the value zone, sideways motion. V1 is essentially a fake out to the downside and reversal, right? Because it goes below bar 1's low, closes back above. I got long here, 9.41 was my entry. I positioned size correctly. I placed my emergency stop, which you just saw me do, 2 ATRs below. Now, what's our end of bar stop on a V1 or V2? End of bar stop on a V1, V2 is a close below halfway of the washout bar. The washout bar here is the V1 bar. Halfway, see how I've put this red line here? There should be some inherent amount of support at that halfway bar. If in the future now it closes below my entry, closes below halfway of the washout bar, I'm out. And you can see it's pretty close. So it gives me a good risk to reward ratio. And then, I didn't mark this up last night. 74 cents above is going to be my trailing stop level. And then if I get to trailing stop level, well, then we go into trailing stop mode. And if we have a close below previous bar's low, we'll get out of half. All right. So that is the trade. That's the setup. You see how close my stop is? My end of bar stop is right here, exactly at halfway of this bar. So on Monday, if it closes below halfway of that bar, I'm simply out for a small loss. But um, in addition to that, you see I have the green box here. Why do I have this green box? This box is what is called a fair value gap. Again, it's another one of the strategies that I use and teach. A fair value gap happens when you break structure to the upside. And we broke structure here on this day when we broke above these highs. So we have three bars, bar 1, 2, 3. The top of bar 1, the bottom of bar 3 is this green area. This is an area that the market never came back to test. It just went straight up, and the market usually likes to come back and test that area. And look what it did. It's exactly came back into that area. But this is the buyable area. This is the buyable area. So not only is it just in general a buyable area, but you've had the return to value, sideways motion, V1 on top of that. This makes that a good trade. Again, I don't know if it's going to work or not, right? But it is valid, and I know exactly what I'm going to do. You know, the other interesting thing, too, is we had this big move up on this high volume. And then as we've come back down, the volume got lower and lower and lower, just kind of consolidating. So that's another good um, indication that we could be going higher. Essentially, all we did is we broke structure, we went to the upside, we had a pullback, we have consolidation, we had the trigger, and hopefully it will continue its upward move. This one is up a little bit, just barely. Let's see. It's up so little it won't even mark it. Yeah, it's up 0.32%. Okay, so those are all the open trades that I still have. Just real quick recap, FedEx up 2.91%, Rio remaining shares up 2.1, I'm sorry. Yeah, remaining shares up 1.22%, UUP down 0.14%, INDA down 0.6%, TLT down 1.6%, AGQ up 12.82%, WBA down 0.32%. So you can see I don't always have profitable trades, but if I'm doing my job correctly, the winners are going to be larger than the losers, and the whole key is to just try to keep your losers small and have a plan to let your winners run. Okay, let's go to the closed trades that I have. I'm out of these trades either because they hit my stop, we had earnings, or I had other reasons to exit the trade. So this is UNG. This is natural gas. I bought natural gas back here on the 18th of October. Why? Well, you can see the green box here. This is a bullish order block. And an order block is basically the lowest close before you have a market structure change. If it comes back down to that level, that's the buyable level. And I also bought it exactly in the order block, but I also bought it at halfway of this big bar up here, which was on the 29th. That was my spot. And so I entered 1303 position size, emergency stop, 2 ATRs below, end of bar stop, closed below 1270, which happened on Friday. Placed my emergency stop here. Not emergency stop. Placed my trailing stop level 1.5 ATRs above. So I bought here at 1303. Next day moved up. Not enough for a profit target. Next day moved up. Did hit a profit target, thankfully. Next day moved up. Did hit another profit target, thankfully. Next day moved up, hit another profit target, thankfully. I mean, look what happened to the trade. Am I glad that I took off partial positions into that strength? Well, yeah, obviously, right? And then here on the 23rd, we got to trailing stop low level, which means now if I have a close below previous bar's low, I'm going to get out of half. So doesn't mean I do anything. It's just I'm in trailing stop level. Next day went down, reversed back up again, hit more profits there. And then here on the 28th, I had my first close below a previous bar's low after reaching trailing stop level. I took off half of the remaining shares that I had. Remember, I had less than I started with because I was selling into this strength, and then close below previous bar's low after reaching trailing stop level. Am I glad that I took off half of the remaining shares there? Of course I am, right? Of course I am, because look what's happened. But again, I took positions off into this strength with the partial profit approach that I use and have been talking about. And then my other rule here, close below previous bar's low, still at profitable levels, drastically reduce the position size, because now in the last week, look what happened. Down, 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 down. And then on Thursday, we barely held 1 penny above my stop, so I held it. And then Friday, that was it. So the remaining shares that I had to get out for a loss for 4.2%. But all in all, this trade was about break even, maybe even a little positive, because of taking the partial profits into strength and then the rule of the close below the previous bar's low. That saved a lot of money. And that's why I have these rules. I have rules for every single type of trade. And every rule I have in there is exactly for a reason. I've been trading for 29 years. I have them in there for a reason. And by the way, I want to mention that um, if you would like to learn more about my trading, I do teach private one-on-one lessons in the evening time via Skype. I love to teach. I've taught many people from all over the world, from absolute beginners all the way to the hedge fund level. I will teach you all 7 of the different trading approaches that I use. The course is 15 hours, 5 sessions. Each session is 3 hours. We do all sorts of teaching. We do all sorts of simulations. And by the time you're done with this course, you will know every rule. You will know exactly how I look at trading and exactly how I trade, and you're going to be a better trader. It's a great course. It's worth every penny. It's $1,750, but it is worth every penny. One, because you get all the knowledge that I have and the experience that I have over the last 29 years, and I'm teaching you one-on-one, and it's the best way. So if you're interested, my email's in the link at the description. Just send me an email and we can start the conversation. Anyway, on UNG here, the remaining shares down 4.24%. But again, the rules made this about a break-even trade, maybe even a little positive, because of the taking the partial profits, taking the being in trailing stop mode and getting out of half. So, you know, when things just go up, you're like, why do you take partial profits? It went higher. Yeah, because these kind of things happen very often. So down 4.24% on UNG out of that one. Microsoft, well, another rule that really helped. So I got into Microsoft back here on the 21st of October. Why? Okay, this is a combination of a deep dip buy, rejection of the 200-day moving average, and the V1. See the V1? Bar 1, bar 2. Bar 2 goes below bar 1's low, closes above bar 1's close. Got in at $418.80. 2 ATR emergency stop below. My end of bar stop is simply going to be a close below the 200-day moving average. That's it. Look how close I am to the 200-day moving average. So my risk to reward ratio was really good. Trailing stop level up here. So I entered 418.80. Next day, ripped higher. What did I do? I took multiple profit targets into that strength. And now I'm also in trailing stop mode. Next day, gapped up a little bit, came down. We have no close below previous bar's low. Next day, up very strongly again. I believe I hit a couple profit targets. Then we moved down, still holding the previous bar's low. Here, gapped way up, thankfully, got me out of a lot more of the partial positions. And then I got out. Why did I get out? Because I don't hold through earnings. You see what happened to Microsoft on earnings. I never hold through earnings. Sometimes holding through earnings is a fast way to make a lot of money, but it's also a quick way to lose a lot of money, which is exactly what you're seeing here. So that was a really nice trade. Glad that I followed my earnings rules, and the remaining shares that I had on Microsoft. Really nice trade. Up about 3.17%. And then IEF. Okay, this one was a losing trade, but it's a good example of a good risk to reward ratio. So I bought IEF back here on the 24th of October. Why? Well, it was a under 200 over 200. Here's the black line. So I position size correctly, 95.10. My emergency stop, 2 ATRs below. My end of bar stop, simply a close below the 200-day moving average and trailing stop level up here. Next day, gapped up a little bit, held the 200-day the next day, and then the next day we closed below the 200. So my end of bar stop triggered, and I got out of the trade for a small loss of, what does that say, 0.43%. Now, did I want to get out of the trade? Not really, but look, I got in, quickly lost my level, got out, wasn't a big deal, and am I glad that I got out? Oh, yeah, I guess so, right? So a good risk to reward ratio, barely closed above the 200, closed below. I simply get out. I can wait. At this point, I can wait for and get over the 30 RSI to get back in, or get over the 200. I can wait, but right now it's a no-go zone. So this down 0.43%, but a good example of a good risk to reward ratio and getting out of quickly when you're wrong. So those are the closed positions on. Those are the closed positions. Loss of 4.24% on UNG, Microsoft gain of 3.17, and IEF loss of 0.34%. Okay, let's go over to the weekly trades. And the weekly trades, of course, weekly bars close on Friday. So I wait till Friday for this bar to close. I did get long Disney here all the way back on the 9th of August. Why? Well, this is a deep dip buy. Deep dip buy under 30 over 30. That was my entry point, or entry signal. 85.90 was my entry. Emergency stop, 2 ATRs below as always. End of bar stop here, 82.95. Have my trailing stop level here. And of course, if it moves up, I'm going to take partial profits. Next week, it did move up. I took a little profit. Then we didn't do much for a month. Then we had 3-4 weeks where it moved up, took some profits here, took some profits here, also in trailing stop mode. So now if I have a close below previous bar's low, I'm going to get out of half. Hasn't done that. We have earnings coming up. I will get out of the position before earnings, and currently this position is up 10.09%. And then the last weekly trade is QLD. This is double leverage Qs. I am short. Why am I short? Well, you see the red box here. This, if it's a red box, I'm probably shorting in that area, right? And this is a fair value gap. I'm sorry, this is an order block. This is the highest bar close. I don't know why this bar moved. There we go. This is the highest bar up close before we broke structure to the downside. So if we come back up into that, if we break structure to the downside, I want to short rallies. Well, I've been in this trade for a while. I got in on the 27th of September at $100.20. Why that price? Well, on this particular week, one, we got into the bearish order block, and two, we ran into halfway of this big down bar. If you have a big down bar and then you get back to halfway of it, generally you're going to find some resistance there. So two things happen. Ran into the resistance of the halfway down bar inside of the bearish order block. So I got short here, $100.20. My stop, I have my 2 ATR emergency stop here as always, but my end of bar stops a close above the high of the order block at 107.11, and I've been fighting with it for over a month here. But then, of course, we had the big down move on Thursday, which brought it down. Slightly profitable, but I'm really glad because I had a loss going there for a while. slightly profitable 0.73%. Now you can see down here the orange line, this is trailing stop level. So if it gets down to this area, then I go into trailing stop mode. But because I'm short, if I get a close above a previous bar's high, I will get out of half. Okay, so on the weeklies again, Disney up 10.09%, and on QLD the short up 0.73%. So okay, those are all the positions: open, close, daily, weekly. Like I said, hope that was helpful. If it was, like I said, appreciate it if you could hit the thumbs up button. And now let's talk a little bit about trading psychology before we move on to the potential trades for next week. Okay, this comes from my good friend Steve Burns. You can follow Steve over on at Twitter or X at @sjosephburns. Has a great channel. He's a really good trader, teacher, coach, author. Check out his books on Amazon. But a lot of what I'm teaching you on the deep dip buys is here from Steve Burns. So let's see what Steve has to say. Trade with a position size that allows you to accept any trading outcome. Know your stress tolerance level. Very important. I've been talking about position size a lot today, and if you remember, I mentioned that in my opinion, it is the most important thing in trading, really, because if you bet the farm on something and it doesn't come through, even if it's a good setup, well, you're in big trouble. So what he says here, trade with the position size that allows you to accept any trading outcome. Know your stress tolerance level. When I teach students, when we talk about position size, a lot of the times people will come up with these big, I use 1%. Some people use 4%. Some people use 5%. And I'm like, look, I know it's easy to say 3, 4, 5%, but in real time, when it really happens, you are going to be stressed out of your mind. It's better to, like Steve says, it's better to use a position size that you're really okay with. So basically what I'm saying is they think they're okay with a 5% emergency stop. In reality, I guarantee you they are not going to be. They're going to go through a lot of stress with that kind of position size. So really the best advice, and what Steve's saying here too, use a small position size. You always trade better when you have a small position size. Why? Because it helps you follow your plan, right? Without all the stress. So it's really good advice to be able to, like Steve says, know your stress tolerance level. I use 1%. Some people use 2%. Some people use 3%. And maybe you're fine with the 3%, but you'll know, your own little GPS will tell you if there's too much stress or not. If you're not sleeping at night, it's probably too much stress. That's a good indicator too. But for my advice, trade small. You're going to trade better, and you're going to get used to those. Your tolerance level will increase as you trade, as you use your systems, as you use your process, as you start to have confidence in them. And then once you start having confidence with them, then yes, you can increase your position size. But listen to what I'm saying, everybody. Position size is crucially important, and I would err on the side of a smaller position size anytime over a large position size. So hope that was helpful. Really come up with a strategy or a formula. Use the one, feel free to use the one that I use because it's a good one, and stick to it. But position size is so important. Okay, let's go over now to the potential trades for next week. Now, I always mention this each week, but it is important. Here I have 9 dailies for next week, 9 potential daily trades. Now, it's possible that all 9 of these could trigger on the same day. Does that mean I take all 9 trades? No, I only take 1 trade per day. I narrow down to the best trade of the day. Even if all 9 of these trigger on Monday, I will find a way to pick the best one. And how do I do that? Well, I look at many things. Which one has the most confluences? Which one has the most entry triggers? Which one has the best risk to reward ratio? Which one is doing better or worse relative to the rest of the market? which one looks better on a higher time frame. These are all things that are important to look at. The devil is in the detail with trading. And again, in my one-on-one course, this is what I teach my students. But last week I had 3 different ones that looked really, really good, all on the same day. And how I had to narrow it down one way or the other. But I looked at the risk reward ratio, I looked at the confluences, I looked at the big picture, were there any double bottoms, bullish divergences, I looked at the larger time frames, I looked at the relative strength of the market, and that's what helped me make my decision. So again, in my one-on-one course, that is what I teach my students. Let's start with Etsy. Okay, so Etsy on Thursday had a change in market structure. We had this downward market structure, and then this big bar up on Thursday that took out these swing highs. This changed Etsy from being in a downtrend to being in an uptrend. If you change from a downward structure to an upward structure, then I want to buy the dips. Conversely, if you're in an uptrend and now you go to a downtrend, then I want to sell the rips or sell the rallies. So this chart is indicating that Etsy has changed from a downward market structure to a bullish market structure, upward market structure, and now I want to buy the dips. Okay, well, where do I buy the dips? Okay, well, there's 2 options here. The blue box here, this is a fair value gap. Remember us talking about fair value gaps? Here's a fair value gap in the blue. The green box is the lowest bar close before market structure change. This is a bullish order block. So there's 2 different areas. A bullish fair value gap is the blue. A bullish order block is the green. Okay, how am I going to manage this, or how am I going to enter? I can't tell you because I don't know what's going to happen. If we came down into the order block here, into the fair value gap here, and had maybe a V1 or a V2, might get there. If it heads down straight down into the green order block, maybe a V1 or a V2 or maybe a rejection of the top of the bullish order block may get long there. So it's hard for me to explain this because I don't know what's going to happen. I'm just telling you that there are 2 buyable zones right here, anywhere from 50.31 to 47.39. But kind of to make it easy, if we came down here, I think ideally, if we came down here, bounced to the top of the order block here, bounced off that, rejected it, and closed back above, that's probably would be where I would want to get long. Because if it rejects the top of the order block, and it may go down and test it, but if it rejects it and comes back up, it still gives me a good risk to reward ratio. I'm a little less inclined to go with the fair value gap unless we have maybe a V1 or a V2. So anyway, Etsy, based upon this chart, has changed to an upward structure. So I want to buy some kind of dip. I just don't know exactly what it's going to look like. But like I said, for this podcast, if we bounce off the top of the order block, if we come down to 48.75 and bounce, that would be a decent location. And then my stop would just be a close below the low of the order block there at 47.43. Coca-Cola. My gosh. Markets are crazy, aren't they? Everybody wants Coca-Cola. Everybody wants Coca-Cola. Everybody wants Coca-Cola. Up, 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 up. Oh, wait, no. Nah, no, don't want it, don't want it, don't want it, don't want it. Isn't that nuts? Just the psychology of just people running over each other just to push it up higher and higher and higher, and then just the complete opposite. Yeah. Well, listen, this is pretty simple. This is the 200-day moving average here. This is a major moving average for Coca-Cola. We have not touched the 200 since all the way back here in April. But look, was this buy off of the 200 back here in April a good area to buy? Well, yeah, obviously, right? So if it comes back down to the 200 again, will it do the same thing? I don't know. Probably not. But when I'm looking at buying at the 200-day moving average, I always look in the past to see, did it respect it last time? It certainly did. It makes it more likely that it will now. But again, we don't know. And again, it's not at the 200-day moving average, not even close. Really, I mean, certainly next week it could get there. But if it gets there on this deep dip buy, very likely I will take a crack at it because Coca-Cola respected the 200-day moving average back here in April and respected it very, very well. Look at that. Just perfect. Came down to it. That's all she wrote. Will those 200 buyers be there again? I don't know. But really, I'm waiting for this trade. I would like to get into Coca-Cola, but again, I need to wait for it to get down there. Maybe it just turns around here and just goes straight up, and I'll miss it. That's okay. But to me, this looks like a pretty good deep dip buy with a good risk to reward ratio. Again, if I get in and then it closes below the 200, even by penny, I'm simply out. Oh, and speaking of deep dip buy, of course, I teach that in my one-on-one course, one of the 7 strategies that I teach. But I also have a really good course on udemy.com where I just teach you all the rules and the setups for deep dip buys. It's very affordable. It's somewhere between $30 to $50 depending on the day. They set the price. I don't set the price. But the link is in the description, and it's 9.5 hours of video. I did a 9.5 hour video course on the deep dip buy specifically, and it's a really, really good course to get started with the deep dip buy because it's pretty simple, right? I'm in above the 200, I'm out below the 200, but I teach you about taking the profit targets and the all the math with the setups and the position sizing and all that. But if you're interested in that, it's a great course. It's affordable, and the link is in the description of this video. So Coca-Cola, yeah, 200-day moving average. That is what I'm looking for. I think that would be a really, really good way to structure a trade off of that 200. So that's what I'm looking for on Coca-Cola. Pfizer, okay. Well, Pfizer, um, I'm simply, again, this is a deep dip buy. I'm looking at the 200-day moving average. And notice, here's the 250-day moving average and the 200-day moving average. So they're kind of dovetailing there together. They're kind of nesting there together. Could be worth an entry if I get a rejection of the 200. Well, 3 things. Either if it closes under the 200, over the 200, that's one approach. Intraday rejection of the 200, that's another approach. Or a bounce at the 200-day moving average. So there's 3 approaches for rejections of the 200-day moving average in the deep dip buy. So we'll see. Not as many confluences, but we'll see if we get a nice reaction and a nice rejection of the 200-day moving average. I may be looking at Pfizer. The Qs. Okay, so beginning of the podcast, I was talking about the Qs and we've changed market structure. Well, the red box here on the Qs, this is an order block from way back when. Here is the highest bar close before market structure changed. So if we get back up to that area, it's more than likely to fail. Well, look at this. Here we got to that area, failed. Then we had 4 days where we fooled around up there. But again, that bearish order block held, right? And in addition to that, look at the blue box. The blue box is an island reversal. We gap up, we go sideways, 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 and then Thursday, we gap down below it all. So that is a legitimate short from the order, from the island reversal. I did not take that trade because I'm already short QLD, but a lot of things happened on this day. So we rejected the order block. We have a bearish island reversal. We broke the long-term trend line to the downside, and we broke structure to the downside. So that's why I mentioned at the beginning of the podcast on the Qs, we have broken structure to the downside. Doesn't mean we can't have a rally back up. We may have a rally back up, certainly. And probably likely so. But because we broke market structure to the downside, I want to be looking at shorting rallies now. And right here at 493.80, that's the bottom of the bearish island reversal. And it dovetails with the trend line. See the trend line that we broke below? That was acting as support. Now that's resistance. And look how they dovetail right there. They dovetail at the bottom of the island reversal. This trend line, which used to be support, is resistance above us. So what I'm looking for would be a short right about there. Somewhere between, well, let's just call it 490, 385 in this area, because that's when you get back to the trend line that is above you as resistance. You also get to the bottom, the bottom of the order block, which is also going to add resistance. So 490, 380, let's call it 490, 380. If we go up and reject that 490, 380, that would be my short entry. And then at that point, I would place my 2 ATR emergency stop above and probably just go into this with a 2 ATR stop, 4 ATR profit target below, because this is a bearish island reversal, but I'm just waiting for it to get back up there. So if we do get up to 493.80 and reject it, very likely I will get short 2 ATR stop, 4 ATR profit target. So those are the cues. Let's look at the SPY now. Okay, SPY is the same thing. Here was our long-term trend line that we broke on Thursday. That is now resistance above us. The red box here, this is the order block. Here's the highest bar close before we broke market structure to the downside. Really, anywhere in this red area for me would be a shortable area, anywhere from 578.43 up to 582.91. Is that right? 78? Yeah. High 582.91, low 578.43. And that's the high of this order block right here. And again, we've broken structure. We broke the trend line. So a rally back up for the way that I trade would be the way to short. Again, if you break structure from the downside to the upside, you want to buy dips. If you break structure from the upside to the downside, you want to sell rips or sell rallies. So for me, a rejection of the bottom of the order block potentially gets short there. A rejection of the trend line gets short there. So yeah, I'm kind of looking to short here, honestly. Verizon. Okay, well, again, this is a good example here, everyone, of looking at this chart. I looked at this chart and went, where would I want to buy Verizon? Do I want to buy it now? No. Would I buy it at the 200-day moving average? Maybe, definitely. Let's look back. Did it respect the 200 last time? Yeah, it certainly did. So, is it going to respect it this time? I don't know, but it's more likely. But the main thing is if it, if it gets all the way to the 200-day moving average, I'm buying it a lot lower than it was, and that is a key level, and it just gives me my line in the sand. If it's below the 200, I'm out. If it's above, I'm in. So, and again, the patience factor. I'm just waiting for the 200-day to come into play. Will I buy it? I don't know. It depends on, the other trade setups that I have here. Maybe they'll be better than Verizon, but it's possible. But I'm looking for the 200-day moving average as potential entry on Verizon. XLRE, okay, that's real estate. Well, that's really fallen off a cliff because of bond yields going up so high. But there is a bit of a potential entry here on XLRE. You see the red line. This is the 100-day moving average. This is also deep dip buy. I don't talk about the 100-day moving average very often, but there is a very strong correlation of a good setup if the price gets to the 100-day moving average at the same time it gets to the 30 RSI. Getting to the 30 RSI and the 200-day moving average, that's a really good risk to reward ratio and high probability trade. But the 100-day and the 30 RSI is another high probability trade. So is it going to get there? I don't know. We've also had the negative third ATR channel in here. That adds some bonus points as well. But I really don't know. I mean, for XLRE, it's going to be up to bond yields. If bond yields continue to go higher, almost certainly real estate will go lower. Makes sense, right? But if we have a bounce in bonds, or in other words, yields come down, you'll most likely have a rally in XLRE as well. So potential for XLRE next week. The only way I would buy it is if we had a rejection of a 30 RSI and a rejection and close back above the 100-day moving average, the red line. Healthcare, XLV. Okay, so this was a legitimate entry on Friday. I didn't take it. I just decided to give it one more day. But 200-day moving average, you can see back here on the 30th, we opened up way below it. We closed back above it. That would have been a legitimate trade, but the next day would have got you out with the close under the 200. Now we close back above. This is a higher low close above the 200-day moving average and the negative 30 ATR channel. And you can see that XLV has come way, way, way down. But I don't know. I didn't buy it. Maybe we go back down and we test it one more time. Maybe we get a V1 or a V2. That would make it a little bit better. The one thing I do like about XLV is that we have a bit of a double bottom bullish divergence. Not a very large one, but we have lows here with deep red. We have lows here, little less red than a little less deep than over here, but not much. But it's something. It's something. But let's just see how XLV reacts to this 200-day moving average. You know, if we got down here to the 250-day moving average, depending on how fast we came down here, we may have a 30 RSI. I mean, would I rather buy at the 200 with a 34 RSI, or would I rather buy at the 250 with a 30 RSI? Well, obviously there. So I'm just going to have to watch this. But if it goes lower, the 250 and the 300 definitely would be interesting potential areas to buy, and maybe the 200. But I just didn't buy it. It was just an under 200, over 200. That was it. Not a lot of confluences. So maybe we go back under, go back over, get a V1 or V2 and a rejection of 200. That'd be better. And Exxon. Wow. Exxon had good earnings, gapped way up, down. Just goes to show you, even if you have good earnings, you know, the market maybe already priced it in. Well, this one's pretty simple on the 200 here. You know, I'm looking at the 200. I look back in time. Did it respect the 200 last time? Oh, yeah, it certainly did. That 200 brought in buyers. Didn't seem like anything wanted to take it up. We rejected the 200. The buyers came in, and then we just raced up. So will it do it again? I have no idea, but it gives me a good structure for the trade. If it rejects the 200, I'm in. Above, I'm out. Below. Okay, so those are the dailies. I only have a few weeklies. Let's take a look real quick. Adobe. Okay, I've been talking about Adobe for probably 3 or 4 or 5 weeks. You can see in the green box here, this is a bullish fair value gap. But I've been talking about the 250-week moving average, which is the purple line, and I highlighted it in blue. That 250-day moving average is legit by itself, but it's also in the bullish fair value gap. And so that is really my key. If we can reject the 250 week, which is now 473.22, so it's about 10 points lower still. We almost got there and bounced, but next week, if we reject the 250 week moving average, I kind of like the trade because one, it gives me a very distinct line in the sand, and the confluence is it also happens in this bullish fair value gap. So that's what I'm looking for, a rejection of the 250 day, which is at 473.22, potentially get long there. Anheuser-Busch, wow. Wow, wow. Let me take you to the daily. Let me see. Look here. Gap up, gap down. There was your abandoned baby. Was it right? It sure was. Okay, a little off track there. Yeah, it rejected the 200 week moving average, Anheuser-Busch, Budweiser, BUD, but I don't like it. I like the 250 week moving average better. And that 250 is at 58.36. So it's about $1 below. But why there? Well, because one, it's the 250-day moving average, and two, it's the top of the bullish order block, the lowest bar close before market structure change. So it's a nice confluence dovetail there. So potentially looking at Budweiser with rejection of the 250-week moving average, 58.36. And then last but not least is Tesla. All right. Well, when you have a big up bar like this, more times than not every single time, but more times than not, the halfway of that big bar is going to add some support. You go up, yes, people sell, come down a little bit, halfway here. Well, I'm not going to base it off the halfway. I'm just, to make it simple, I'm going to base it off the 200-day moving, or 200-week moving average here. Next week, if we come down, we reject the 200-day moving average. I'm fine with it because one, it's in the value zone, and rejection of the 200-day moving average on the, or 200-week moving average is legit as well. But I like it because it's prior you had the big up bar. Yes, it's normal to have a bit of a pullback and a consolidation before you move higher here. So basically on Tesla, just a rejection of the 200-week moving average, I would consider. So that's what I have for you this week, everyone. If you found it helpful, I really would appreciate it if you hit the thumbs up button. Feel free to leave your comments and questions. I do my very best to get back with you. If you'd like to work with me, like I said, I'd love to be able to teach you in the 15-hour course that I have. You're going to learn a lot. You're going to learn to trade exactly how I do and look at the market how I do. And I think it's a really good investment in yourself. So if you're interested, my email is in the link of this YouTube video. Just send me an email. Again, on udemy.com, I have the video course, and the link is in the description of this YouTube. It's a really good video course. It's 9.5 hours of video, and it's very, very affordable for what you get. And anything else? Let's see. I hope you have a good weekend. If you could, try to go out and do something nice for somebody today. If you could try to go out and do something nice for an animal today, that would be twice as good. Animals appreciate acts of kindness just like humans do. And, you know, make the day of another human and an animal. And if you haven't subscribed to the channel, do that. And how about we just end up with have a really good weekend. Next week's going to be, of course, an interesting week with the elections and the market and everything. But please be careful as always. And I really appreciate you being here. Have fun, everyone. And God willing, I'll see you next week. Take care. Bye-bye.
Government required disclaimer. Stock, options, futures, and forex trading is not appropriate for everyone. While there is a potential for large rewards, there is also a substantial risk of loss associated with trading. The material in this video or live broadcast is not geared towards any particular individual or to any particular financial situation and is not intended to meet the particular investment objectives of any viewer. This video or live broadcast, like all instructional materials produced by Gossett Trading and Mentoring LLC, is created and published for informational and educational purposes only. Any and all information contained in, implied, or referenced by this video or live broadcast is not to be construed as investment advice, and no representation is made that any individual or entity involved in production of this video or live broadcast is an investment or financial advisor or is registered or authorized to give any financial advice. We are publishers and educators only. Therefore, the various producers of this video or live broadcast will not accept liability for any loss or damage of any kind which may arise either directly or indirectly out of the use of any of this material, including any loss of profit. No representation is made that any account or investment will or is likely to achieve the profit or losses demonstrated. We recommend consultation with a licensed and qualified professional before making any investment decision. This video or live broadcast is not to be construed as an offer to buy or sell any security, financial instrument, or financial product of any kind. Notice is hereby given that any individual or entity involved in production of this video or live broadcast or their clients may have an interest in any security, financial instrument, or financial product mentioned or referenced. Any simulated or hypothetical performance result depicted does not represent actual trading and therefore may under or overcompensate for the impact of various market factors such as lack of liquidity. Thank you.